In our last assumption, we're going to use weighted average, and we're going to use a perpetual moving average method. With this method, every time a purchase occurs, a new weighted average cost per unit is going to be calculated and applied to these items. So basically, after each purchase, we're going to take the cost of the goods that are currently available for sale and divide it by the number of units currently available for sale. So this is going to adjust each time we make a purchase. So starting out, we've got our January 1 beginning inventory. Put 1 beginning. Okay. We had 100 units at 14 apiece. Okay. Our total for these is 100 times 14. This is currently our total cost available. Okay. So what I'm going to be doing down here is I'm going to put right here total units available, total costs available. This is going to adjust as we make sales and more purchases. Okay. So what I'm going to be doing is I'm going to have this be this all the way down through here, and it'll adjust as I add more things in the rows. Okay. And then here, same thing. I'm going to take basically the costs as we add more purchases and sales all the way through. We're going to kind of see these. We're going to use these numbers so that we can determine. We'll put current weighted average. We're going to use this number right here. What it's going to do is we're going to take at any given time the total cost available divided by the total units available. And that number is what we're going to use when we're applying it to the actual sale of units. Okay. So currently the weighted average per unit cost is going to be $14 per unit because we only have those 100 units that we purchased at $14 per unit. So let's start with that March 20th sale. Okay. We had a March 20th sale of 50 units. Okay. We're going to take the current weighted average, and that's going to be our cost per unit right now. So 14 is where we are right now. So we sold 50 at 14 at 700. So in these numbers over here, this is basically like my inventory calculation that's going on as we're going through the period. Okay. I'm going to subtract out 50. I'm going to subtract out $700 worth. Okay. So right now I have 50 units available at a total cost of 700. The current weighted average is still 14. But on April 10th, I made a purchase. Okay, I purchased 150 units at $16 each. Take 150 times 16. Notice how my current weighted average now changed. Now it's $15.50. So when I make a sale on July 15th, I'm going to be using this new current weighted average. So I sold 100 units. I'm going to put 15.5 right here. 100 times 15.5. We're using all of these to calculate our cost of goods sold. Okay. We made another sale on September 30th. And that was of 50 units. Current weighted average is still 15.5. So I take 50 times 15.5. And I apologize. What I should have done is subtracted out the 100, and we'll see that that would be the same. 100 units that we sold at $15.50. Negative. Sorry about that. So the current weighted average was still $15.50. We sold another 50 at $7.75. Current weighted average is still at $15.50. Okay. But on October 10th, we made another purchase. If I could spell it correctly, that would probably be helpful. So October 10th, we make another purchase. We purchased 200 units at 17 apiece. 200 times 17, Suddenly our current weighted average is now 16.7. So we're going to be using that when we sell 150 units on December 15th. December 15th, we sell 150 units at 16.7 per unit for 2505. And the very last entry we have over there is December 31st. We've got ending inventory of 100 units. We can go ahead and put here negative 150 and negative 2505. So weighted average for the remaining 100 units ends up being 1,670. We get our total cost of goods sold over here by adding up these costs from the sales. And that ends up being 5,530. If we add these two together, we end up with the total cost available for sale of 7,200.